Thank you. I'll be the happy moderator of this panel today on transfer pricing for asset managers. It sounds extremely loud. We have targeted a number of different topics today for asset managers in particular, and even a bit more into the details, private equity, real estate, infrastructure, investors. And we'll start right away into the topic. Maybe just one point before we begin. When we speak of asset management in general and transfer pricing, there are many, many different topics that could be addressed. Today, we speak really of any transfer pricing consideration you might have on the corporate side of asset managers. So we will not enter into the details of what happens when you make a deal and when you set up a number of companies, very often through Luxembourg, and all intercompany transactions that happen here, just for the sake of clarity for everyone. Today, we really focus on the management part, the asset management part. And to be sure we are all on the same page and all aligned, I suggest we start with the basics and with the arm's length principle. Victoria, if you want to open the discussion and maybe refresh the memory of everyone of what is this famous arm's length principle we are all speaking of when it comes to transfer pricing.
Hello, everyone. Thank you for the question, Sophie, and I'm very happy to be here today with you. Starting with the basics, as you said, the arm's length principle is the cornerstone of transfer pricing. It is stipulated in Article 9 of the OECD Model Tax Convention, and it states that associated enterprises should enter into financial and commercial relations according to market conditions. And if they don't do so, their taxable profits will be adjusted to the levels as if third parties would have entered into these transactions. Sounds a bit complicated, but in principle, it is the rule that the associated enterprises that are part of the same group should conduct their business relations with one another in alignment with the market conditions and not differently. In Luxembourg, it's Article 56 and 56 bis that provide for the arm's length principle and make it a legal obligation in Luxembourg for taxpayers to comply with it. It is also stipulated in Article 164, paragraph 3, that if certain benefits are provided to shareholders due to their relation with their subsidiaries, this can be requalified as hidden profit distribution and taxed accordingly. It is important to also mention that in Luxembourg, we have specificities with respect to the arm's length principle and the TP circular on financial transactions. That is very important for financial companies that conduct intragroup financing activities. In the transfer pricing circular, the tax authorities laid out specific requirements, the substance requirements, so how financial companies can comply with the arm's length principle in their particular dealings with on-lending and with obtaining funds and on-lending them to further. So it is important to consider the arm's length principle at the inception of the transaction, at the setup of the fund, at the setup of the overall relations between the different jurisdictions. And it is also very important to monitor the arm's length principle throughout the lifetime of the structure. When we have changes like reorganizations, to consider whether what we change would be done by third parties, whether third parties would agree to these changes, and to monitor it on an ongoing basis.
Thank you. So in essence, and to simplify, each time we have an intercompany transaction, so a transaction happening between two companies of the same group, we need to ensure at the inception and throughout the life of this transaction that it is priced under market conditions. But then we often have the question that why is it really relevant for asset managers? Because you were saying when we set up a fund, we have to think of transfer pricing. But you can see investors being unrelated parties to the asset managers themselves. They are not part of the same group. So Majide, maybe you want to elaborate a bit on why does it matter at the end to speak of transfer pricing when we speak of an asset manager?
Sure. So investment fund structures, whether UCITS or alternative investment funds, cover a wide range of fund management services. It can be, for example, portfolio management, risk management, marketing, fund administration, and so on. These services are rendered by one company or by several companies. And these companies can be part of the same group, and then we will consider them as related parties, or they can be third parties. In general, in Luxembourg, the fund will be managed by a management company that will be actually performing these fund management services. And usually, this management company will delegate certain of its functions to other parties, like advisors, portfolio manager, distributors, and so on. Well, in practice, the extent of the delegation model can change from one case to another. We can see management companies that are delegating most of their functions to other parties, and they will keep the oversight over the delegated functions, and maybe also perform risk management depending on the regulatory requirements. In this case, from a transfer pricing perspective, we will consider that the functional profile will be quite limited for this management company. We also see cases where the management company can actually perform more than the bare minimum functions. For example, it will also undertake the distribution activities. And in this case, the management company will have an extended functional profile. And we can also see the cases where the management company can actually perform all or most of the functions at its own level. And in this case, we will consider it as having a full-fledged functional profile. So, as I said, in reality, the selected delegation model can be different from one structure to another, but one aspect always remains. So whenever there are other different parties that are involved in the provision of these management services, it should be ensured that each of the parties are remunerated based on their functional profile. So what this means in terms of fee flow, so an overall fund management fee will be indeed specified in the fund of in the prospectus of the fund, and the investors agree and accept this overall management fee. From a transfer pricing perspective, as the investors to the fund are not related parties, we will consider that this overall management fee is at arm's length. But this is just one side of the story, because then we need to actually look at how this overall management fee needs to be allocated between the different parties in order to remunerate them. And this is where the arm's length principle will enter into the game, because we need to ensure that the portion that is allocated to related parties out of this global management fee is actually determined at arm's length.
And this is where we start to speak a bit with our transfer pricing jargon. What is the functional profile? Which functions are delegated? How to remunerate this? So might be good to demystify a bit the transfer pricing topic behind all those wording which we use all the time. Oliver, wouldn't you mind maybe to run us through a number of case studies?
Sure. So here, probably just to run you through the investment structure so that we are all on the same page. So here we have a Luxembourg RIFE established in the legal form of a special limited partnership. The investors are investing into the RIFE. The RIFE uses the fund in order to invest via Luxembourg master company and Luxembourg or local property companies into mostly foreign real estate assets. So the Luxembourg property company would be financed by a mixture of equity and debt, and so would be Lux Masterco. However, when we speak about fund management services, we would look at the top of the structure. So that means we speak about the general partner, then the Luxembourg IFM here, which is a third-party IFM, and the foreign IFM, which is established here in France. So if you now look at what would the transfer pricing analysis look like in this very case, I mean, first of all, as already mentioned, like the overall fund management fee that is paid by the investors is deemed to be arm's length because the investors are third parties to the general or to the asset manager. So let's assume we have a number of 2% of the assets under management, just for the sake of discussion. Then the next question is like, what is with our Luxembourg third-party IFM? Here we can also make the case that as it's the third party, the remuneration that is negotiated between the third-party IFM and the Luxembourg fund is deemed to be arm's length. So that means here we would need to focus on the Luxembourg general partner and the foreign IFM when it comes to like determining an arm's length remuneration. And here it would be, say like the focus in this transfer price analysis would be to establish first the overall fund management fee is arm's length. Then the second point, the remuneration paid to the third party IFM is arm's length. And then we need to determine an arm's length remuneration for the general partner. So it would be typically like a remuneration for the functions performed. Here, typically, we would expect like a cost plus remuneration, and if we have a normal situation where we have, say, like a cost of 100,000, and then we say like, yeah, cost plus 30%, obviously subject to a case-by-case analysis. So then 130 should be the share of the general partner for corporate governance in the structure. And here, the residual profit, the residual or the remaining fund management fee would then be attributed to the foreign IFM. Here's a slightly different setup. So the investment structure is the same, but I mean, we are focusing at the top of the investment structure. This time, we do not have a third-party Luxembourg IFM, but we have an IFM of the group, and we have a foreign IFM in Germany. So there is a certain delegation to the foreign IFM. Now doing or performing our transfer pricing analysis, again, the same thing. So the overall fund management fee is by nature arm's length because it's third parties agreeing to pay a certain level of fund management fee. Then we would need again to think about the remuneration for the general partner. Typically it would be a cost plus remuneration. And then we need to think about the remaining fund management fee, meaning the fund management fee minus that what is paid to the general partner. That would then need to be allocated to the Luxembourg and the foreign IFM. And here it depends on the functional risk profile of the Luxembourg and the foreign IFM. So if you have a very highly integrated, say like profile of both IFMs, then we would probably look at the profit split method in order to attribute profits to the Luxembourg and the foreign IFM. In this case, we would look into all the different functions. We would say like put certain levels of importance to each function and then determine overall approximation of how much profit should be attributed to the Luxembourg and the foreign IFM. If the Luxembourg IFM has a functional risk profile like a Luxembourg third-party IFM, meaning like more or less the Luxembourg IFM does that what you would expect from a third-party IFM, then we could rely on the remuneration charged by third-party IFMs, applying the CAP method. I mean, obviously, depending on where, I mean, in this situation, the foreign IFM is situated, one might have like different incentives to either have like the Luxembourg company realizing more or less profitability. I mean, if you have like here, Germany and Luxembourg, it does not make a big difference. Both are high tax jurisdictions. And so one would probably not mind so much. And maybe there would be a majority going to Germany here. When we have a highly integrated functional risk profile. On the other hand, if you have like a foreign IFM situated in a jurisdiction like Guernsey, maybe you would like to have even more profits like to be attributed to that entity. That is a general tendency. Now looking at a third example that is even easier. So here we just have the Luxembourg GP and a Luxembourg IFM. So again, we would considers that the fund management fee being paid by the limited partners being arm's length by nature. So we would focus on the arm's length remuneration for the GP, probably a cost plus remuneration, and here the remaining fee would be paid to the Luxembourg AFM. Now, these are 3 examples. I mean, in practice, we have been seeing situations that are much more complex than that. So one always need to look on a case-by-case basis, map the intra-group and the transactions between unrelated parties in order then to perform the transfer pricing analysis.
Thank you. You're concluding on, well, after 3 case studies on the fact that it can even be more complex than this. And when we hear of, well, all that you said, it's visible that we have to understand really what is the role of each entity in the value chain. You were mentioning different countries and that it can be different depending on who's the counterparty, which means somehow a lot of documentation to be performed. You have mentioned a number of transfer pricing methods that can be applied. And when we speak with clients, we hear a lot that transfer pricing is all about compliance, transfer pricing documentation, that it can be very burdensome. But on our side, as practitioners, we see transfer pricing in a broad range of areas, and it would probably be interesting to share with the audience, aside of transfer pricing documentation, how can transfer pricing be used? How can you use transfer pricing in the context of asset management? Maybe Majide, you want to open the discussion on this.
So unfortunately, I cannot say the contrary. Well, yes, transfer pricing is about documentation. But it's not only this, and I think it's not really appropriate to reduce transfer pricing to compliance. And I will now give you 3 examples where we can see the importance of the TP documentation. The first example is, for instance, the tax assessment. If the Luxembourg tax authorities, during their tax assessment, adjust transfer price, considering that it is not arm's length and evidencing this, it will be the responsibility of the taxpayer to actually prove the contrary and to go against this adjustment. And in fact, in the absence of any TP documentation or any TP support, it is quite complicated to prove that the transaction was actually at arm's length. Another example that I have in mind is the context of the annual audit of the accounts. The auditors actually, when they are performing the audit, they can request to see the TP documentation in order to approve the accounts. And also here we should not forget that also in the accounts, usually there is a note saying that the related party transactions are conducted at arm's length. So here it's also the relevance of the TP documentation. A last example that I have in mind is the context of mergers and acquisitions. And actually a purchaser can request the TP documentation from the seller in the context of a due diligence related to the group that it wants to acquire or part of the group. And we can see that in the absence of the documentation, well, the purchaser actually can negotiate the purchase price and also push to include quite strong warranties in the sale purchase agreements. In all the 3 examples that I mentioned, one thing is also important to note. If there is not already a TP documentation in place, preparing one in the context of these situations will be quite challenging. First, in terms of timing, because you will not maybe have the time to perform something that is, good in a way, and also you don't have the security on the outcome of the TP analysis. So, which is why we can actually conclude that transfer pricing should be seen also as a strong risk mitigation tool rather than a simple compliance exercise.
Thank you. So we have compliance, we have risk mitigation. Is there anything else to think of when it comes to transfer pricing?
Yes, transfer pricing documentation is quite important in justification of the profit allocation. And why is that? It is because we need to mitigate the risk of double taxation. Transfer pricing considerations are mainly predominantly important in a cross-border context. Of course, domestic transactions should also be compliant with the arm's length principle, but it was put in place basically to fight the profit shifting that we have seen in the past years. Historically, multinational enterprises were using intragroup arrangements to shift profits from high tax jurisdictions to low tax ones. And this was an instrument through transfer pricing. Now we have seen shift in this behavior in the recent years. Now, in the post-BEPS world, when the base erosion and profit shifting plan of OECD with the action plans were enacted, the multinational enterprises actually changed their behavior. But what didn't change is the focus of the tax authorities in transfer pricing audits, because now they're equipped with the arm's length principle and with more tools to actually look at how profits are extracted from their jurisdictions elsewhere. And they're much more focused on checking whether the transfer pricing position taken in the tax returns are indeed well supported with robust transfer pricing documentation. Before, the one-sided approach of telling a story the tax authorities in a given country was working for some years, but no longer this is the case. And we need to be very much aware that the transfer pricing position should be aligned in the jurisdictions involved in the intercompany transactions, and the TP documentation should contain sufficient details as to the tax positions taken in the foreign jurisdictions. And as you can see in the dispute resolutions mechanism later on, this is very much relevant, as you will imagine that the tax authorities might speak about this dispute. It is important to stress that the transfer pricing documentation should be prepared contemporaneously, and this remains the strongest tool to substantiate the profit allocation into the different jurisdictions where the multinational enterprises operate.
Thank you. It's interesting because you are, well, both of you and probably a number of people are very convinced that transfer pricing can be used not only to confirm that a company is compliant with law, but also to address questions from auditors, from tax authorities, to show that profits have been properly allocated. But do we have any kind of counterexample, or can we illustrate that when a taxpayer is not following those rules, somehow is not preparing transfer pricing documentation, that it can get into trouble? Did this ever happen in Luxembourg?
No, this never happened. No, just kidding.
Okay, so next question.
No. Fun besides. So there was one important case law from 2018. This is not related to fund management services, but which can provide a lot of good information how transfer, or what is the value of transfer pricing documentation, and what is the timing aspect in this value. So here we had an investment structure where a French resident individual invested via a Luxembourg company into French real estate. The Luxembourg company has been largely financed by an interest-bearing loan that had an interest rate of 12%. So what is the tax treatment of the Luxembourg company? So in principle, the income from the French real estate would be tax exempt in Luxembourg in accordance with the applicable tax treaty. And the interest charged on the loan would not be deductible for tax purposes in Luxembourg. So it would be deductible in France to the extent that the interest rate adheres to the arm's length standard. Now, here the tax authorities challenged the taxpayer that, by the way, did not produce any transfer pricing documentation when implementing the investment structure. The tax authorities reached a conclusion that the arm's length interest rate should be 3.5%. What does that mean? Even though the income from the French real estate is not taxable in Luxembourg, if the Luxembourg company pays excessive interest payments to the French resident individual, the excessive part of the interest would be reclassified into a deemed dividend distribution that is subject to 15% Luxembourg withholding tax. So that was the tax risk that we are talking about. Then, after receiving the challenge, the taxpayer produced like a first TP study where they reached a conclusion that the arm's length interest rate should be somewhere between 3.2 and 7.9%. nice to do the TP study, but you see if the interest rate chosen is 12%, I mean, even according to their own analysis, the interest rate was too high by at least like 4%. Then the case went in front of the Luxembourg tribunal. For that purpose, a second TP study has been performed. Here, the conclusion reached was an arm's length range of interest rates somewhere between 10 and 20%. That's obviously a very broad range. And in the end, the court decided in favor of the Luxembourg tax authorities. Now, looking at the what happened here, I mean, we do not know the actual fact pattern, but we understand one thing. I mean, first of all, like here, the second TP study with a 10% say like range of arm's length interest rates does not make any sense, because you would always try to say like limit the range of arm's length range and reduce it via statistical methods in order to be more meaningful, because 10 to 20% means nothing. On top of that, it's pretty clear that the first and the second TP study seem to be mutually exclusive, so they are inconsistent with each other, which is not really helpful to make your case. At the same time, one can also say, like, yeah, I mean, the tax authorities reached the conclusion that the arm's length interest rate would always be 3.5%, which also doesn't make any sense, because we always need to determine, based on a case-by-case basis, what the arm's length interest rate is. Nevertheless, the court decided in favor of the tax authorities, and that tells us, like, yeah, the power of transfer pricing documentation to mitigate potential tax risk is the highest if it's produced alongside the implementation of an investment. Because if you are producing transfer pricing documentation once you are challenged by the tax authorities, I mean, you obviously can do that. But I mean, if you then, say, like, coincidentally reach the conclusion that what you have been chosen in your transaction is arm's length, is probably a bit suspicious, and it does not take a lot of imagination on the part of the tax authorities to challenge you.
Yeah, and well, clearly, if you would implement the same transaction between third parties, no third party would agree to decide whether the price is correct or not 5 years later or 5 years after implementing the transaction. And well, here we are speaking of a loan, but we can replicate the same reasoning to any transaction that would happen between an asset manager, well, within an asset management group. So delegation of portfolio management, sales and marketing, whatever needs to be thought of at inception of the transaction. This is kind of a counterexample because, well, in the sense that it's pretty obvious that the taxpayer was not very diligent when it came to transfer pricing. But when we look at the state of the market now, a lot of companies are taking transfer pricing seriously, are trying to set transfer pricing policies in the best way possible, are reviewing the value chain. But still, what we hear in the corridors is that there's a lot of transfer pricing audits happening in Luxembourg now and not only abroad. So, well, Oliver, if I can keep you speaking, can you explain a bit what you see on the market at the moment?
Yeah, I mean, speaking about like tax audits, I mean, probably first of all, like defining what is a tax audit. So there might be formal tax audits spanning over several years, and there might be tax audits as part of the review of the tax return, and that would typically also span over several years because we have in Luxembourg this procedure where we have a preliminary assessment of the tax returns in accordance with the statements made by the taxpayer. And then the tax authorities have the possibility within the next 5 years to open the case and to challenge the taxpayer. So that means, like, yeah, we would expect that the tax authorities after 2, 3, 4 years would look into the intragroup transaction or would look into the tax returns. And then what we have been seeing is, like, when it comes to tax audits, what is always put under the microscope is transfer pricing. Because transfer pricing, that is always where one can have like different positions. And the first question by the tax authority is always like, please provide me with your transfer pricing documentation and your computations, because I want to look into it. And here it's therefore very important to take a proactive stance on transfer pricing documentation, because if the answer to the question, did you produce transfer pricing documentation, is like, no, I mean, it's not a good start to begin with.
Or when we try to prepare it in a very short time frame, usually they see it very, very quickly.
Yeah,
So.
you just make yourself open to challenge, and probably also to makes that point. I mean, what we have been seeing over the last years, I mean, the tax authorities are becoming more sophisticated. It's not only anymore like finance margins. They are becoming more sophisticated, and they are more and more challenging. In particular, on the transfer pricing front, where I mean, transfer pricing is not an exact science. Two people can have two different views, and therefore, I mean, it makes absolutely sense to be prepared here.
Yeah, and speaking of sophistication, I think that one of the reasons why they are much better now when it comes to transfer pricing in the asset management world is that they have been challenged heavily by foreign tax authorities. So they have seen what foreign tax authorities are doing when it comes to certain specific transactions. Maybe Majide, you want to share a bit what is happening abroad and how it affects Luxembourg entities?
Sure. So whenever we talk about a cross-border related party transaction, obviously two countries will be involved in the transaction. So even if the transaction is not challenged by one country, it can still be the case in the other one. And whenever a Luxembourg entity is the counterpart to a related party transaction, well, any adjustment that is applied by the foreign tax authorities on this transaction will have a naturally direct impact on the Luxembourg tax position of the entity. This in terms of a double taxation or any corresponding adjustment that needs also to be considered from a Luxembourg perspective. I can maybe illustrate this with a case where actually we can think about a Luxembourg management company, so performing fund management services, and in the course of its activities decided to delegate the portfolio management to its subsidiary in Italy. This Italian subsidiary, the function related to the portfolio management, it will be, for example, any investment research activities, preparation of reports to the management company, also giving advice and recommendations on the assets to be sold or purchased, and monitoring of the portfolio. And for these services, obviously, the Italian subsidiary will receive a certain remuneration, which will be a portion of the overall management fee. Well, it can be the case that when the Italian tax authorities will look at this transaction, they will consider that the functions that are performed by the Italian subsidiary are actually key functions if we put in the light of the overall asset management group. And they can argue to have a bigger portion actually of the overall management fee on the grounds that the functions that is performed is actually bringing the value and is creating the value in the overall value chain. This is actually what we are seeing in practice. We see an increasing level of scrutiny on the TP aspects across the various jurisdictions, where actually the tax authorities may be, let's say, more aggressive than in Luxembourg, and Italy was a good example for that, but also like Germany and other countries. So it is important also in terms of transfer pricing analysis to not have maybe one-sided approach, meaning that when you prepare the analysis, consider, okay, I will look at the management company in Luxembourg, I will look at the functions, and I will determine the remuneration that it needs at its level for its functions. Because we can see that in the context of foreign audits, the value chain actually will enter into account, so it might be more relevant at the beginning to already consider like a double-sided approach and to understand what is the value chain, what are the key value drivers in this chain, who is performing these functions and where the risks are located, and then remunerate all the related party transactions.
Yeah. And on top of this, you were mentioning the value drivers and the value chain. It's clear that in those foreign audits, we see tax authorities very much focused on that and trying to argue that the main value drivers are in their country to attract much more profits to, in your case, the portfolio management company in Italy, to whatever investment advisor in Germany, to the sales and marketing branch in France, and so on. And we are speaking there usually of very, very material amounts, which create a double taxation that cannot be ignored, that we don't see in practice today asset managers saying, okay, we will settle and this is it. We will not pursue anything else because of this very material double taxation. And maybe there, Victoria, you want to share a bit of your experience of what are the tools. There are tools which exist to release, at least partially, multinational groups from double taxation, but are they used by asset managers and how do they work in practice?
Yes, certainly. When we speak about dispute resolutions mechanisms, it's important to say that they're evolving in terms of time efficiency, in terms of capabilities of the different parties, and in terms of sophistications. In the context of tax and transfer pricing double taxation issues, we have the mutual agreement procedures as prescribed by Article 25 of the OECD Model Tax Convention. And this is the main procedure that can be used for taxpayers to resolve their double taxation. Let's put a bit of a framework on the mutual agreement procedure before going into the statistics. Mutual agreement procedure is available to taxpayers that suffer double taxations through double tax treaties if Article 25 is implemented in the double tax treaty with the corresponding jurisdiction. It is also available for EU member states through the EU Arbitration Convention for transfer pricing matters and also the EU directive that is covering also EU member states. Is applicable as of fiscal year 2018. So when we have these cases in practice, we have to assess for our clients what is the way for them to go for the mutual agreement procedure. And why I decided to show you also some statistics is to illustrate the dynamics on the mutual agreement procedures on the OECD level. We see that 75% of the cases are resolved positively. So if you face double taxation as a taxpayer, you have basically 75% chances that your mutual agreement procedure will end with a positive outcome by resolving the double taxation, which is great news and is consistent with what we have seen in 2020 statistics. So this shows consistency on the tax administrations and taxpayers to pursue their rights there. What else is important to see from these statistics is that 13% more cases were closed, tax cases were closed in 2021 as compared to 2020, and 22% more cases were closed for transfer pricing cases specifically. This shows dynamism and willingness of the tax authorities to cooperate and resolve the mutual agreement procedures faster. Indeed, it is interesting to note that the time frame for a mutual agreement procedure is usually is normally around 2 years, and the statistics shows that for other cases, for tax cases, this remains consistent with last year of 21 months. But if you face transfer pricing case, indeed, you might expect longer time. It's around 32 months as per 21 statistics, and this is reduced with 3 months in 35 months in 2020. Why the transfer pricing cases take longer to mitigate the double taxation? It's because of complexity, and it's also because usually it's not only 2 jurisdictions, but more that are involved and in this procedure. What else is a factor is that the different tax authorities have different level of sophistications in pursuing these matters, expertise, resources. So of course, if you deal with disputes in countries that are less developed in this sense, you will wait longer. But the outcome is positive, and we should keep in mind that the mutual agreement procedure remains the main way for taxpayers to resolve their double tax issues. And where is Luxembourg in this picture? It shows that the OECD statistics shows that Luxembourg is in line with the trends and actually shows intensity, sophistication, and increased capabilities of the Luxembourg tax authorities. If you see, the cases started on overall basis are around 200 in 2021, and about the same amount were closed in 2021, which is a great sign for the Luxembourg tax authorities that is progressing on this, and for the taxpayers should be a sign that we can move forward, and tax authorities are willing to help in this process of resolving double taxation.
Well, thank you. That's good news. So despite the fact that it's very long, we should continue going there because the chances to win, at least to release the double taxation are very high. We have spoken a lot of tax authorities since the beginning of this discussion, but you were just mentioning intensity, capabilities, or increased capabilities, and that made me think of one last probably topic that has not been addressed at all. It's regulatory considerations. Asset managers are quite heavily regulated, not all of them, but most of them, and there are certain pressures on prices from a regulatory perspective, which one might guess has some interactions with transfer pricing. Don't you mind to elaborate a bit on this?
Regulatory aspects are important for transfer pricing, and we should be aligned when we disclose certain positions within the regulator and in the transfer pricing documentation. We have seen that this was not really the focus in the last years, but it should be one, because we have the new draft law from March this year that is supposed to be voted in June this year, which increases the collaboration, transparency, and exchange of information between the CSSF, the regulator, and the tax authorities. Currently, we have the CSSF circular that elaborates on matters of tax offenses and how this should be reported to the regulator in such cases. And now with the draft law, we have the capabilities of the regulator to request tax information for specific companies to check their position as part of its due diligence obligation to verify certain position. So this is quite a change and quite a shift. And what I think is important for asset managers is to really check their disclosures and to make sure that the transfer pricing documentation does not contradict them or involve any discrepancies therefrom.
Yeah, might sound a bit frightening at first sight. So to imagine a collaboration or enhanced collaboration between the regulator on one side, who's already performing a number of investigations, and the tax authorities. Majide, do you have recommendations in that respect? How to prepare to that, or what do we have to keep in mind? What is really important to deal with in that context?
Yes, so Victoria mentioned alignment between transfer pricing and regulatory, and I will just underline this aspect again. So a specific framework is already provided by the regulators in terms of functions, substance, and processes that are required. These requirements are important throughout the life of the company, but also they are actually considered as conditions to even take up the activities. For example, if we take the framework of the AIFM law, it will actually give a number of details that are expected from the management company in terms of functions that is performed, in terms of the officers that are needed, what will these officers do, how is the risk management procedures, and so on. And these are also actually disclosed at the very beginning when the management company will need to have the authorization in order to undertake these activities. And the license will be actually provided at that moment, but depending on the context that was described. And this is where actually we can see the interaction with transfer pricing, because when we perform a transfer pricing analysis, one of the most important components, as you understood, I guess, it will be the functional analysis. And what is the aim of that? Well, we will in this analysis describe what are the functions performed by the entity, what are the risks that are assumed, and the assets used. And this will also consider the different personnel that we can have at this level, the functions of these personnel, their experience, and so on. For example, if we consider that in the regulatory context, it was provided that the delegation of certain activities will be actually performed, and that the management company will still keep at all times the oversight on these delegated functions, and then explaining how this will be actually performed. Well, the transfer pricing functional analysis needs also to take this into account, because the TP documentation should tell the same story. And this is why actually the regulatory aspects are important, because they will have an impact on how to address transfer pricing. And I think it's also important to mention the importance of this alignment between the story that is told in the transfer pricing documentation and to the regulator, in the context that Victoria was mentioning, in an increased exchange of information. Because if we consider that, well, the transfer pricing documentation is a check by the regulator, and it can be seen that, well, actually the story is not what was told in order to conduct the activities and get the license, well, this can lead to what? Penalties, maybe, or maybe the withdrawal of the license, and how this will affect the structure. So consequences can be bear in mind, I think. And so we can say, to conclude, two aspects are important here. To have an appropriate transfer pricing documentation, yes, but not only, we also need to ensure that the functions that are described, the risks that are described in this transfer pricing documentation are actually consistent with the regulatory characterization of the entities. And this, of course, we should not forget that it will also have an impact on the remuneration, because from a transfer pricing perspective, the remuneration is always related to the functions.
It's interesting, this last point, because at the end it shows that we are speaking a lot of transfer pricing that needs to be aligned with the regulatory requirements. You describe in your license application a number of functions, of controls that you will have in Luxembourg, and it needs to be described in the same way in the transfer pricing analysis. But at the end, what does it mean is that we need to find the right methods, the right transfer pricing methods, to allocate a reasonable or an arm's length amount of profits to those functions which have been described in the first place to the regulator. Sorry, you wanted to, no.
Just wanted to say the aim when we conduct the transfer pricing analysis is actually what you mentioned, is to organize the operations in a way that will fit the regulatory aspects.
Yeah, and that we cannot work anymore on an isolated basis in our crystal tower of transfer pricing practitioners in a way. Before we conclude, Oliver, do you have any other thoughts or recommendations when it comes to this world of asset managers tackling transfer pricing?
Thank you for asking. Yeah, maybe 2 points. We have been speaking a lot about like transfer pricing documentation, and probably one practical aspect: how would we render a transfer pricing analysis? Because I mean, typically you would have like Luxembourg and foreign entities being involved. However, I mean, how we are doing it, typically we would be performing the transfer pricing analysis, because at the same time, the remuneration of all the parties must be arm's length. And that means like, yeah, 100% of the remuneration need to be distributed in an arm's length fashion. And why can we do that? Because normally all the relevant jurisdictions adhere to the OECD transfer pricing guidelines. And what we would do in practice is like then ask for a review by a local transfer pricing person, in order to ensure compliance with all local requirements. So that would be point one. And point two would be, I mean, you have been speaking a lot about like, yeah, transfer pricing documentation, potentially part of compliance, potentially or very useful as a tool to mitigate tax risk. However, there might also be an element of creativity, because I mean, obviously the transfer pricing outcome depends on the fact pattern. And while we have heard we have limitations in how we can design the fact pattern and allocate functions to different entities, and we must not jeopardize the regulatory position. However, in practice, we often have a certain amount of flexibility where we can say this and this activity should be performed rather by the one than the other entity, and that can then also optimize the overall transfer pricing outcome, which should then be consistent with the expectation of the asset manager.
Thank you very much. If I can try to summarize very briefly all that has been said, I think it's obvious to everyone that one way or another, you need to think of transfer pricing. Because either the Luxembourg tax authorities will ask some questions at a certain point of time. If it's not the Luxembourg authorities, that might very well come from foreign authorities, not only European, but really worldwide. We see audits everywhere now that have an impact on Luxembourg companies. And if it's not tax authorities, then maybe your financial auditors will be there and will not want to sign your financial statements with OTP documentation. And next year might even be the regulator. So if I can finish on a note that sounds a bit more positive than you're all at risk, I think it is the right moment for everyone to think of the position of Luxembourg entities within asset management groups and to try to review whether the way the group transfer pricing policy has been put in place at a certain point in time reflects or still reflects what you live in your day-to-day, every day in Luxembourg. Does the remuneration that you see in Luxembourg and in all the counterparties in your group reflects the risks that you think you are taking in Luxembourg because you are the one in control of certain transactions, you are the one making certain decisions that nobody else in the group can take? Or vice versa, do you think that the remuneration which you as asset manager in Luxembourg is granting to a number of entities within the group truly reflects the value that they are bringing, the contribution that they have in the group? Think of your portfolio managers, your investment advisors. Who decides at the end? Who has the power there? And do you think that the profit is appropriately allocated depending on those different notions of controls and of decision powers? This is what tax authorities look at. This is also what regulators look at very frequently and more. So it's definitely time to not necessarily revisit transfer pricing, but at least ensure that the policy you're applying is still in line with the group in which you live and you work. Which questions do you have for the panel?
Should I stand?
Sorry?
Should I stand or I can sit?
Yes, sure.
Okay, I have a question for Victoria, please. Your explanation about the base erosion profit shifting, since it is not per se illegal, what do you think that the OECD in partnership with tax authorities could do to at least reduce the aggressive tax arrangement, especially here in Luxembourg and some cross-border countries? And secondly, maybe you touched that ATAD 3, Anti-Tax Avoidance Directive. What is your lecture about it?
So BEPS plan of the OECD indeed triggered some changes in many tax jurisdictions, but as you said, they were not sufficient to tackle all the profit shifting that we see. And that's why the OECD initiated Pillar 1 and Pillar 2 exercise, which is extremely complex, but we hope that it will reduce the negative effect of double non-taxation or profit shifting. Now to this question, whether and how the Pillar 1 and Pillar 2 will be implemented and whether this will be the right solution for all the parties that discuss this matter is for us to see. We have seen some progress and some determination from the OECD member states and part of the inclusive framework, but we cannot predict at the moment whether this in practice will be the right way forward. The efforts that we see from the member states show that indeed, even if this is not sufficient, there will be other measures and other initiatives to tackle this problem.
The question has not been asked to me, but I have difficulties to hold the horses, because when we speak about aggressive tax planning, you know, like we had in the meantime after the BEPS project, ATAD 1, ATAD 2, providing for a whole battery of anti-abuse legislation. Aggressive tax planning, by definition, can be challenged by this anti-abuse legislation, be it interest limitation rules, general anti-abuse rule, hybrid mismatch rules. So it means like everything that is today not today based on existing rules that have been implemented in the meantime be challenged by the tax authorities is by definition not aggressive tax planning. And Pillar 2 has nothing to do with aggressive tax planning, but is an additional measure just to increase taxes. But it's not aggressive tax planning.
Any other question? If I may, we had questions for you. Have you already encountered, like just a hands up just to see, and then it will probably be a good moment to go for a well-deserved cocktail, but have you experienced audits, either in Luxembourg or abroad? So some of you, yes, but it's still a story to come for many of you. But well, that's interesting to see, because well, in the usual practice that we have, we see really more and more audits, but there are so many taxpayers in Luxembourg that there are still a number of them, and thankfully that have not experienced yet how the tax administration can act. So.
But it's good because now you can be prepared actually for it. So it's not a bad thing in the end.
Well, thank you very much. Thanks, everyone.